trading alone isn't going to create long-term wealth for us. And if creating long-term wealth is something that is of interest to you, then stick around for this video. I want to share with you the wealth wheel. This is the strategy that I use that incorporates trading as part of my overall wealth building strategy. Now, before we get started, this isn't financial advice, and I say this every time, of course, but what I'm going to share with you today isn't going to be applicable for everyone in every country of residence, in every level, if you will, of life, time in your life, but parts of it will be. So what I want to encourage you to do is take this as an educational video, educational purposes, but then go and get your independent advice based on your country and its own rules and regulations. With that out of the way, why the wealth wheel? It's because of this phrase: money loves speed, but wealth loves time, right? Trading is speed. Trading is just bringing money in, but often sending it back out again rather than keeping it. Wealth loves time. So we need something to appreciate over an extended period of time to actually build wealth. So why the wealth wheel? Trading can provide us income, but money in a trading account, it's risky. And with every trade that you make and every upward movement of the market, your risk also increases relative to if you just bought the stock, right? The wealth wheel traps your wealth rather than continues to increase risk. What I mean by that, very simply, if you've been trading Nvidia forever and a day and you're still trading it now, your risk is up around the $200 mark, right? Whereas if you just simply bought Nvidia back down here in the 20s, 50s, 100s, your risk is locked in at that amount, right? So your risk is never increasing as part of locking in your wealth. But trading, it's always increasing. And we want to be able to funnel our trading into wealth. Now, QQQ has returned an average of 21% per year in the past 10 years. This includes the bear market of 22 when we lost 37%, the COVID crash where we lost 30%, the tariffs tantrum last year when we lost 23%, right? So we have a wealth building asset that is returning phenomenal numbers. And if we're traders, this is the part that people miss. If we're traders and we have to pay tax, we don't need to just simply beat this average of 20% return, right? If you're on an average tax rate of, say, 30%, you need to return at least 32% on your trading account to outpace just buy and hold. So the wealth wheel allows you to always have a growing portfolio, even if you have poor trading months and or years, right? This is the number that we want to aim for, at least 32% for our trading account. Now the whole wealth wheel, it's how the wealthy do it, right? There's different rules for the rich. We know that, but we can access them. It's just that no one teaches us how. No one gives us this system. No one has shown us the ultimate wealth wheel before and let us know that, hey, as an average Joe, we can actually do this. And that's what I want to share with you today. How can we access these rules out there that the rich have access to? Now, one other thing before we dive into the mechanics of the wealth wheel. Money is energy, right? Money needs a job. It needs a purpose. It's attracted to stability, structure, and certainty. And when you're clear about the job your money will take on, more will flow to you. The wealth wheel gives you clarity on the job that your money will take on. And here's the cool thing. I've seen this not just for myself and not just in trading, but in trading, in businesses that I've had. Whenever I've had a very clear job for my income, more of it just arrives. And I've seen this with clients as well. So structure, absolutely, the energetics of it all, whether you actively believe it or not, It's a thing. Let's run through the wealth wheel. I want to start by giving you an overview of each of the components, and then I'll dive into the mechanics of what do we actually do in each of these segments. So first is the build. Now, build is all about building your income. So it might be your job or a business. For many of us, it's trading, and this is what I actively teach and support inside of the 50K Club. This is our active income that eventually we actually don't want to rely on, right? As much as I like trading, as much as I love the businesses that I run, I don't want to have to do it forever. So the goal here in the build phase is to safely earn steady money that we flow into step number 2, all right? For the sake of everything that we talk about today related to build, I'm just going to pretend it's trading. It's not your job, it's not your business, it's just trading, okay? Number 2, the buy. This is where we're buying quality growth assets to appreciate over time. And I'll show you exactly what we buy in this section. But ultimately, this is the wealth. Build is not wealth, build is income. Buy is wealth. And borrow, this is where we get to borrow against our assets so we never have to sell them. This is what keeps the wealth. This is what the rich do. This is how we create generational wealth. It's how we leave something for our children, for our grandchildren, if we so choose to. So let's get deep into build by trading, right? In my trading, I like to aim for 5% per month. So 3% is the minimum that you need to outpace QQQ. We just said 32% per year outpaces QQQ. 3% per month gives you a little bit of wiggle room to make sure that you can still outpace just simply having your money sitting in the queues. Here's the ultimate goal in your build account. Don't lose the capital, because if you lose the capital, then we don't have the funds to flow into the buy section, right? So don't lose capital. Here's what we need to work out. Number 1, of your trading account, what percentage of your profits will you move to the buy? Okay. For me personally, I move 100%. I can though. I've got other sources of income. I don't rely on it. Taxes as well. I don't take money out of my trading account for taxes. The income that I have outside of my trading account, I use to pay my taxes from trading. So take that into account as well. And here's the thing. The best risk management strategy is actually to not trade with more than you need to, right? I'll share a bit of why about that in a moment. And I'm going to help you to find out, well, what size account, what size trading account do you actually need to be able to reach the end goal? Okay, we'll get onto that, don't you worry. But for now, this is what you need to think about. What percentage will you need to move into your buy account? And you might still be growing your trading account. So you might still be growing your build account. So maybe to start with, you're moving 50% over, right? But as long as something is moving into this buy account regularly, you'll be in the wealth wheel, you'll be building wealth. Now, when I say the best risk management strategy is to not trade with more than you need to, it's because of this phenomenon, that word, that when our account gets too big, we make dumb decisions. It just happens. I've not met anyone who, doesn't matter if they're trading with a $10,000 account or multiple millions, when the account gets beyond the size they're comfortable with, dumb decisions are made, you get caught in the emotions, you chase hype, and ultimately you lose the extra. So if you've ever found yourself stuck at a trading ceiling, it's because of this. So keeping your trading account at a level you're comfortable with keeps you trading, and it keeps you trading well. The rest of it, we're funneling into build, okay? Let's now do some math. If you move, let's say $5,000 per month into your buy bucket, how many years do you need to do that for you to reach your minimum account value. To do that, we need to focus on compound interest. So I want to show you a really cool tool to help you come up with this number, right? And this number here, you'll work out on your own. How much can you move into your buy bucket? So whatever this number is for you, you do the math around that. Okay, so to do this math, we need a compound interest calculator. This is just simply, this is the URL up here, thecalculatorsite.com. Google compound interest calculator and you'll find one. So what we want to do here is put in our initial investment. So this is how much we have in our build account already, or our buy account, sorry. Let's say we've got 100,000. So that's already what we have invested maybe into the SPY or the Qs or some other hold account. Interest rate. Now we've said that over the last 10 years, the Qs have averaged roughly 20-ish%. I'm going to bring this down to 15% annually, just for safety's sake, right? Over the last 20 years, the Qs have actually returned around 15%. So this number here seems pretty safe to me. And I'm going to change this compound frequency to yearly. Years, I'm just going to push that out to 10 years. Now, regular deposits, I'm leaving it at monthly, although I'll show you when we actually deposit the extra funds. But for now, let's say that I'm depositing 5,000 monthly and just hit calculate. Now, instantly we can see our 100,000 has grown with $5,000 deposited every month. It's grown to 1.7 million in just 10 years. That's kind of cool. But these are the numbers that we're going to use for our future calculations. So this interest number here is basically the amount that your account is earning each year. Now, if we want to take, let's say, $100,000 out of our portfolio every year to live off of, then we're going to be looking here for, okay, when do we get above 100,000? So I'm going to use year number 7 and it's at 123. We could use year number 6 at 99, but I'm going to go year number 7 at 123. And what this tells us over the side here is that the balance of the account at that point in time would be 975,000. I'm going to write that number down because that'll be important later. But we can see here in 7 years, this entire system, our wealth wheel, will be able to sustain us after 7 years if these numbers are true, right? If we're depositing more, maybe we can deposit 10,000 a month. Then we can see, oh, we can get to that number even sooner. So come and play around on a compound interest calculator. Find where your sort of sweet spot is. This is just kind of almost as well, kind of like your reality check, right? To see, okay, how much do I need per month and how long might it take me to get to the point where the amount that I would want to pull out every year is actually being earned as interest. Okay, so now we've figured out with our build, so with our trading, how much per month we need to filter into our buy to get to our goal, right? So buy your wealth. This is all about moving from risky, which is your trading account, into something more stable. Here's what's really cool. It also removes FOMO because when we have large drops or huge runs, we're always buying. So this last week when the markets dropped and a lot of people have been saying, oh, I've got no cash to buy anything, to buy the dip, I've been just buying because I've had positions that I've closed in profit that I then funnel into my buy, okay? It also allows for your overall portfolio to recover from drops faster, as because we're buying on the way down, it means that if we're buying at $100, we've dropped from 150 to 100, we're now buying at 100 on the way up. Everything that we've bought is going into the green fast, right? So it balances your portfolio as well. So what are we buying? Now for me, this is all about buying stable growth ETFs as the majority of the purchase. So I'm talking SPMO, QQQ, VGT, and some SPY. Then, and this part is new to me, small allocations, so around about 10% to 2 and 3 times leverage ETFs. So think TQQQ and SSO. I'm not going to explain the mechanics around this, but in a second, I'm going to share with you someone who I learnt this off of, and I was like, that makes a lot of sense to me. And then also some income assets. So think CHPY, QQQI. I'll explain where these fit into the portfolio in just a moment. Henrique Wealth Academy, he's on YouTube. This is where I learnt about the leveraged ETFs and the fact that, you know what, it's not the whole, they will go down and you will lose on volatility and things like that. So go check him out if you want to learn a bit more about that. But the next step of buy is when. When do we actually buy? Well, for me, I buy as soon as my trading profit becomes realized. Now, the reason why I don't buy as soon as I make the trade and that cash lands in my account is because if I close the trade early, I got to give part of that cash back. So what I'm doing is every time a trade is realized, I'm buying. Granted, if I'm only realizing $50 for the day, then I'll just, sit that there until maybe the end of the week, or I've closed out something else that makes the buy worth it. By the time you pay, at least for me, trading fees, you want something somewhat significant. So what typically happens is that my sold puts are realized gains when the market's moving up. And oftentimes, not always, because a sold call can also be profitable when the market's moving up, especially if it's called away. But sold calls become profitable also on the way down, right? So this means I'm always buying whether the market's going up or down. Here's something else. I don't save any money for the dip. A lot of people say, buy twice as much on the way down, but that requires sitting capital to the side. And I found this very interesting article that shows that that's actually not the best way to go. And I want to show you a few reasons why. All this run up here, if I was just putting even 10% of my trading profits to the side, waiting to buy the dip, let's wait, then I haven't invested that money through here, right? Where am I probably investing it? Well, if this is the bottom of this dip, here. And that doesn't make sense, because if I just continually invested on the way up, it means that I've bought at every single level from here through here. Often as well, consolidation is where bottoms usually come back to potentially anyway, right? So if I'm doing most of my buying through consolidation, which I will be anyway, because it's where most of the time of the market is, most of the time of the market was through here, then I'm buying at good rates anyway. And what I saw, this is through Archbridge. You can just simply Google Archbridge invest at all-time highs and you'll find this full research, which I found so fascinating. So this is comparing investing at an initial 10% drop from all-time high, investing at all-time high, and investing anytime. And over the last 5 years, if we're waiting for an initial 10% drop, our overall return is only 40% because we don't have enough money in the market through these times here, right? This drop so far, I think it's about 6-7%. So a 10% drop isn't even going to get us back to these levels that we would have missed buying at. Investing at all-time highs has actually performed the best in every time frame relative to the last 5 years, right? So I found that really fascinating. Buying at all-time highs, which makes sense, right? Every run up, every high is an all-time high. So I just found that fascinating. So that's why I just buy as soon as I've got the cash realized. So the goal of buying is that we're aiming to build a portfolio that's large enough to live off and not from the income that it produces. So this is not a dividend portfolio, and also not from selling, but from step 3 of the wealth wheel, which is borrowing. And this is the part that keeps the wealth. This is how the rich get richer, and this is how they avoid paying taxes, right? We all know the stories of the rich don't pay tax. This is why. They're not selling their assets. Now, when it comes to doing this, this is the part that's country dependent. In the US, you can do it really well because you're just allowed to get money, kind of, it seems like, no matter what, right? In Australia, it doesn't work as well, but I do have a workaround. So, why do we want to borrow? Let's do some math first. If we sell $100,000 worth of shares, we'll pay $30,000 in tax, and we miss out on that 100K growing by 20% for the year, right? I'm using 30K in tax because as an Australian, we now, thank you government, do not have a capital gains tax discount, and we now have a minimum 30% on all capital gains. So we don't even get access anymore to tax-free thresholds. We don't get access to tax rates that are lower than 30%. So it'll be a minimum of $30,000 in tax. As a side note, it's why I'm looking to, one of the reasons at least, why I'm looking to move out of Australia and get myself into a much more wealth-friendly country. Story for another day though. So instantly, if we sell, we're losing $50,000 just in 1 year. This doesn't even take into account the compounding effect. As soon as we take that $100,000 out, we're not getting 20% on it this year, which would have made that $100,000, $120,000. We're not getting the 20% the following year, which is 20% now on $120,000. There is just so much lost when we sell. So instead, what we can do is take a margin loan or a security-backed loan against our shares and withdraw the cash to live off. We can buy a car, we can buy a house, we can buy groceries, we can do anything. Now in the US, it's super easy because you can literally have margin on your portfolio and take the cash out. Send the cash to your bank account, done, right? The rates are around 5 to 6% currently on margin loans, interest rates that is. And when your portfolio is growing at 20%, your returns are outweighing your interest. Even if your return comes down, so if we go back to 15% on average and rates go up a little bit, 7, 8, 9%, as long as there's still a gap, you still come out ahead. And that doesn't even take into account the paying of the tax. So even if it was flipped a little, you're probably still coming out ahead. So in the US, super duper easy. Here, I'll show my Australian hack in a moment. To be fair, I don't know European countries. I don't know any other countries, their specific systems around this. So this is the case where it pays to wherever your tax residency in, just learn how you can access margin or security-backed loans because it'll differ. Now, here's the cool thing. These loans never ever have to be paid back. So it's not like a personal loan that's paid back in 5 to 7 years or a mortgage that's paid back over 30 years. These never have to be paid back unless you get a margin call. And that's unlikely for a few reasons. We're only going to start doing this when our account can handle it, which is why we did that calculation before, where we knew the value of our account versus the income that we would want to earn from it. We'll do some more math around that in a moment. Plus, there are strategies to protect the downside. Things like buying puts when it seems like we might be riding really high and we want to protect a bit of a drop, and selling calls. So if we've got an account that's full of, say, QQQ, at the right time, because we don't want these shares to ever be called away, but if things are looking like, oh, we're coming down, we can potentially sell calls to protect a bit of this downside, right? I won't go into all of that today. This is all just around the structure. And it's also why we buy broad market ETFs, because we don't have a singular stock risk. And also, an ETF, QQQ, SPY, usually has lower margin requirements than an individual stock. And it's also less likely for that margin requirement to increase randomly. Whereas on an individual stock, we've got all of those risks. So the likelihood of a margin call is very, very small. And I'm going to show you how eventually our margin that we've actually got borrowed ends up being a smaller and smaller percentage of our account. So here's the workaround in Australia. The reason why we can't do it is that we can't withdraw from a margin account cash. So we can only withdraw actual cash from a margin account, not borrowing, so not the margin itself. Margin itself, though, we can buy stock. So what we would have to do is sell our $100,000 worth and pay our 30% tax, and then we can use our margin to buy back that position, okay? The margin interest, it's then tax deductible, so it's a little bit of a relief from having to pay this 30% in tax. Asterisks, speak to your advisor to just make sure it is deductible for you. So yes, we've paid the tax, but we haven't lost the position. So we at least still have our shares that are still growing at 20% per year, okay? The other thing to note in Australia is in America, the amount of margin that you can borrow is relevant to the size of your account. The higher your account, the more you can borrow. In Australia, we're capped. So each broker will have a maximum dollar value of margin that they will give you. So what that means is that you may end up with a few accounts everywhere to max out the margin on each account. It's messy, but it at least gives you a little bit of this ability. Or you can just look to get out of Australia. So this is the very simple version of the wealth wheel, okay? What we haven't touched on yet is using margin to also buy your position. If you're using margin to buy along the way as well, you're going to have much larger returns, some more risk as well, of course, but larger returns. It's something that you can look to implement into the wealth wheel. But for now, we just want to focus on the simplicity of what this structure can be. Here's what I want to show you. Now that we've got all of the pieces together, I'm just going to go and ask ChatGPT with you to run these numbers to see if we ever get into a position where we're borrowing more than what our account can handle. So let's come and talk to ChatGPT together. Okay, I just firstly want to stop back at this calculation we did with the initial investment. So saying that our account that we have is worth $100,000 today, an average of 15% per year over 10 years with $5,000 deposits each month. So if I wanted 100,000, that would be, let's call it here, 123. The number that I want is this 975. So this is the size of the account that I would need for the 15% growth rate to be above the amount that I would want to take from the account each year. So I'm just going to simply ask ChatGPT, if I have 975,000 in the stock market, growing at 15% per year, conservatively, and I take a $100,000 margin loan each year, what does that look like? So here it's told me portfolio growth, margin borrowed, and the end portfolio value, right? The next, and then it's come out to 15 and 20 years. So my portfolio is still growing at a rate that's larger than what I'm taking cash out, right? You can continue to read through this, but the next part that I want to know is now tell me what my LVR, loan to value ratio, would be at each year. And now he's thinking. Okay, so we can see that as the years go, I reach a maximum of kind of 26%, meaning I'll have $800,000 worth of margin taken out, and I'll have about 2.9 million worth of value in my portfolio. And then it starts to decline, right? Because the growth of this is outweighing the rate at which the margin's growing, of course. So let me now ask, and it's giving us our, like, what's the worst case scenario? So worst case scenario, if we get up to our maximum LVR and then we have a drop of 40%, what would that loan value look like? Okay. Now, what it hasn't taken into account is if we had dividend stocks, or if we take into account as well the extra returns that we'll get for having our TQQQ or our QLD, right? For having our leverage stocks in there. This is all very, very conservative. The other thing it's not taking into account is continuing to add anything beyond the 975. So if we get to 975, which is where we've said that we can take some money out, we might still have our trading account and we can still continue to funnel money from our trading, our build, into our buy. So let's ask that question. If I spend, let's say the first 5 years, also contributing 5K per month, what do the numbers then look like? Everything else stays the same. You'll know what that means. Thinking. There we go. It keeps our LVR lower. Our portfolio continues to climb higher. Without contributions, our portfolio would be 3.95 million, our debt $1 million, and our LVR 25. With continuing contributions, our portfolio 4.76, our debt $1 million, our LVR 21%, right? Now, the thing to just, I guess, play around with is the numbers, right? So sure, it also doesn't take into account that, in year 10, if we're living off of $100,000 in year 1, we're probably going to need a little bit more to live off in year 10. So then we can ask, well, take into account CPI and help me work out what it would all look like if I'm taking out 100,000 plus CPI every year. Or maybe you don't need 100,000, or maybe you're taking out, I don't know, a little bit more 1 year because the interest rate on your margin loan might be less than the interest rate on your home loan, or whatever it might be, right? Just play with the numbers. But this is a very easy system to implement as long as you remain structured in actually purchasing, in funneling your money from the build to the buy, from the build to the buy. As long as we're doing that over and over again, the goal is to just continually grow the value of our portfolio without ever needing to sell anything, because it continues to grow in value just like that, right? So that is it. Just to recap, build is the income machine to buy the wealth. Buying is the wealth, and then borrowing is how the wealthy continue to grow their wealth. Like I said in the beginning, take this wealth wheel system as the structure and mold it to your country's regulation, mold it to the income that you're able to produce, and just have a look at what would it take to get to the point where you can live off potential borrowings on your account. Some people may not be able to do the borrow phase at all. That's fine. You can still do build, buy, but then your borrow is going to have to become sell. As long as your buy is large enough, your sell part of it can still continue to, like, your portfolio can still continue to outgrow the amount you're selling, right? The dividends as well continue to add to the buy. When we get dividends, we buy. We get dividends, we buy. So the point of the dividends being in there, even if it's just a small percentage of our portfolio, is so that we've always got something in the buy cycle. So that is that. I hope you found this helpful. I did just want to share the entire concept around what I do with my trading profits, because my goal isn't to have the largest trading account out there, because my goal isn't to live off of trading income, right? I use the trading income to fund the entire wealth wheel. I would love to know what you think of this as well. Drop it in the comments. Let me know if this is something you've already implemented, if you've implemented it partially, even if it's something that you're interested in learning a bit more about and I can do a bit more content around this. Whatever it is, just drop some comments below. I would love to hear from you.